And it's historical, you know, and the Spanish speakers, what now, what next?
So I'm gonna give you guys a call back. I'm on the live stream or the Zoom. Sorry about that. I was on the phone with friends.
Yes. I mean, no, we can't.
Paul, I know you can hear me, man. Thank you for joining, my friend. And thank you everybody who took time out of their day to jump on this call. So Mark should be joining us hopefully in a second here. He was in a different room that I had sent him a link for. But in the essence of time, I just want to kick it off a little bit about myself and my team here at Emeritus. So for those of you that don't know me, I'm Dom DeSantis. I'm your local retirement plan representative here at Emeritus Retirement. I'm very passionate about the retirement plan business. I've been at it for almost 15 years. And I've worked at some really great organizations. And fortunately, I've been very blessed in my career to work with some great people where, like much of us, you learn from some of the best in the business, right? So very passionate about retirement. And my most, I think, important attribute that I have is I'm a hard worker. And I think everybody says that when they meet someone new, but I mean it. I'll go above and beyond for my advisor partners. We only distribute our product through you guys, so you're my lifeline. And everything we do is advisor-centric. Everything that we focus on is helping you really to sell, grow, and retain corporate retirement plans. So today, I've brought a subject matter expert on, and one of our best partners. His name is Mark Fishbein. Mark has been working with Emeritus, I think, over a decade at least. And what he's going to talk about today is something that I think can help you in your practice two separate ways. So audited plans. What that means is for a retirement plan, as many of you know, there's a 5500 document that has to be filed for the plan, which is essentially a tax return. And Mark may want to virtually punch me in the face for describing it that way, but it really is. So it's a document that every retirement plan has to file every year. It's public information. And the beauty of it is it's a good prospecting tool for you because you can find this data, and I can help you do that if you'd like to talk offline after our call. I want to keep this on track. But then secondly, it also is a way for you to understand the information that's out there on your existing plan. So if you're currently doing retirement plan business, I can't even tell you how many advisors I meet with a week. When I'm talking with them, they're not even aware that their client's 5500 is out there on the Department of Labor website. So think of this as a way for you to better understand the retirement plan, and really from an important component of it, which is the administration piece. And then lastly, an audit applies to larger retirement plans. So think a group of more than 100 employees at least. They will require an audit. Mark and his firm actually help a lot of their clients through filing the 5500 and then also navigating a 401k plan audit, which can happen. And that's probably the most valuable thing he's going to talk about today is if your client is being audited by the Department of Labor and they're reviewing the books and everything to do with the 401k, what are they realistically going to look for? Because I think there's a lot of different information out there on what they'll look at, but Mark is going to touch on the most important things about it. Before I turn it over to my colleague, Anna, we're a team. So Anna Chavez is my internal partner. I'm blessed to have her on the team. She's far better looking than me and makes a way better impression with people than I do. But with that being said, Anna is a hard worker just like me. So, and I really do view her as a partner. She has a bright future in this business. I hope I have her as long as I can here, but she's very much involved in our organization in many different levels too. And I know that she's going to be successful here in whatever her next move is for sure. But I hope I keep her as long as I can. But with that being said, I'd love to turn it over to Anna just so you guys can get to know her a little better.
Hello, I'm Anna Chavez. As Dom said, I'm his internal partner, and thank you for all those kind words, Dom. I really appreciate it. I am Dom's right-hand woman. Anytime there's proposal requests, prospecting, I'm kind of running behind the scenes, putting the actual numbers together, putting the proposal, and I am here for any support throughout the sales process, any questions about paperwork. But my role is many different hats. I am always here to help in whatever way I can. Dom is truly the expert, but I am always happy to be a resource if anything is ever needed. And I will go ahead and hand this off to Mark Fishbein.
Good morning, everybody. Mark Fishbein. Going to talk about 401k plan audits today. Just so you have a little background on myself and my company. I've been a third-party administrator going on 30 years now. I started my own firm back in 2017. We have 7 employees in the company, but I am day-to-day hands-on with every single client. So a little bit of our secret sauce is every time a client has a question, every time there's a something needs to be processed, I'm involved with everything with regard to the plan. I'm copied in on all emails. Your clients, you receive copies of all emails, so you're not caught off guard by anything. And the CPA is also included. The CPA is obviously very important because all these are retirement plan deductions, and we want to make sure the proper deductions are being taken for your clients. But that's a little background of our office. And Anna, can you go to the next clip, please? The next slide. Yep. So that's information on our company. Type of plans we work on are 401k plans, profit sharing plans, safe harbor, defined benefit, cash balance plans. We have one-person solo plans. We do a lot of solo plans, and I'll explain to you why, because it's a big audit thing that we run into a lot, believe it or not, and I'll explain to you why in a little bit. And our biggest client is a little over 500 employees, as Dom mentioned before. Plans are required to have an audit. Now, when I say audit, it doesn't mean an IRS audit. It means an accountant audit, where you have a third-party accountant come in and review the plan. They changed the rules a couple of years ago. Usually it was based on over 100 eligible employees that would trigger the audit, but it's something where it's now based on account balances. Okay, so if you have a client that has 200 eligible employees, but only 20 are contributing to the plan, then no audit is required. That is a new rule from a couple of years ago. But on the other hand, it's very important, and this is something else I'll touch on in a couple of minutes, terminated participants, get them out of the plan because they count towards that audit number. So keep that in mind. When you hear the term audit, it could mean an accountant's audit. Now, accountant's audit could cost $10,000 to $15,000. You don't want your clients going through that. So that's why it's important to have a TPA in the plan. Okay. Anna, can you go to the next slide, please? Okay, so let's talk about plan audits. I've done a bunch of audits in my 30-year history. Since 2017, since we started the business, 2 clients have been audited, and audits are not necessarily related to the retirement plan, first of all. It could be something else going on at the company. It could be something where they haven't filed business tax returns. It could be a complaint from an employee or things like that. I'll touch on that slide in a little bit. So don't always assume there's something wrong with the plan when your client calls about an audit, okay? So kind of go over the different topics I have here is, and I'll give you a real life experience in a minute, is, you might get a call as a financial advisor. Oh my gosh, I got this letter in the mail from the IRS. They want to audit the 401k plan. What do? They want 5 pages of documents. There's a ton of stuff that they want, and I'm panicking. And at that point, your first thing is to advise your client. Number one is to acknowledge the IRS. Okay. One of the plans that I got audited, they got the letter in the mail, they ignored it. They got a call from the IRS, they ignored it because they thought it was a crank call or a not legitimate call. Eventually, they got a certified letter in the mail from the IRS. That is not the way you want to start the process. IRS case officers are very reasonable. They're very easy to work with. Where you get them upset is if you ignore them, okay? When they request something, just acknowledge it. It might not be easy to get that day. Acknowledge it. So that's the first thing the client should do is just let the case officer know that they got the letter in the mail, number one. Number two is obviously get a hold of the TPA, okay? Because what happens at that point is the TPA kind of steps in and says to the client, first of all, we got this, okay? Not a problem. We're going to handle it. We're going to do 95% of the legwork for you, okay? Client is like, oh my gosh, you're a lifesaver. Great, okay? Some clients sit there and say, no, I'll take care of it myself, and it's a total disaster and a mess. That's why you hire a TPA. That's why you hire an unbundled TPA, okay? We have some financial advisors that are the theory of bundled, which means you go to, for example, a payroll company to have them do all the work on your plan. In these situations, they're going to throw a lot of it in the client's lap, okay? That is why it's important to hire an unbundled TPA. Unbundled TPA means all we do is administration work, okay? We take all the burden off of you as the financial advisor, okay? What we do at that point is we do a power of attorney, and we do what's called a Form 15314, which allows the IRS to send us email correspondence back and forth. The IRS has their own portal system that you upload documents to, and we're going back and forth and stuff like that. Once that happens, I can step in and handle everything related to the audit, okay? And start doing some discovery and stuff like that, okay? You know, when we're doing the audits, we have about 90% of the information. The only thing we might not have are corporate tax returns, quarterly payroll tax filings. What's a little unique about our business is when we're doing annual reviews of our plan and doing the 5500s is we request the payroll report when we're doing it. So we already have that information. You'd be surprised how many times a client sends a census to the TPA and they're giving them wrong compensation. They're giving them net compensation on there. Well, I want the payroll report so I can verify all that stuff. When the IRS does an audit, they don't care what's on a census report. They want to see that the payroll report ties to what was deposited to the plan versus deposited or versus what's reported on the 5500. That is very important throughout the process because the IRS takes it very seriously that people's 401k money went into their account. They consider it embezzlement if you're not depositing money into people's 401k account and they come into an audit and find that out. Okay, so it's very important. That's one of the good things about working with our office is we have that payroll report. We can verify that versus what was deposited to Emeritus, to the accounts and things like that, and pull that and give that directly to the IRS and say, hey, here's your paper trail and stuff, because that's one of the things they want to see is did the employees get their money? Okay. Now, the other thing I'm going to mention, which is the last thing on the slide, is what happens in the audit. Okay. What happens is that the IRS will normally say, hey, we're going to come to your client's office and schedule the audit. Okay. In the past, years and years ago, back 20 years ago, they would be nice and come to the TPA's office and go through everything and stuff like that. And they don't do that anymore. They want to go to the client's actual business. They want to check it out. And they will start an interview process that usually takes about 30 minutes and ask a bunch of questions related to the retirement plan. That is where it's important you have your TPA on the call, okay? Because they're not going to know questions related to the plan, believe it or not. And that's why we're there, is to protect them and make sure the right answers are given. And those go very smooth if you have your TPA involved. So it's very important to have them there, okay? And then they'll begin the audit review and what needs to be done with regard to information they need. When we do an audit, the TPA, it's important we get all the information over to them, okay? The good news is you got advisors really just handing it off. I might come to you and say, hey, you know, I need a fee disclosure or something like that, or they want to see something on the fees and stuff, okay? But a lot of the stuff I'm already have, or I'm getting from Dom at Emeritus and saying, hey, Dom, we need this report, this report, this report, okay? Important to have a TPA in there. record keepers I'm going to touch on in a minute, but we have some clients that use brokerage accounts for their retirement plans. Brokerage accounts, I have no problem with. They're great. It just makes it a lot more difficult in the audit because in a record keeper, I can pull the deposits, send over a PDF. In a brokerage account, I got to pull statements. I got to highlight deposits. Sometimes there's money commingled in there and stuff like that because they don't do that in brokerage accounts. That's why it's very good in 401k plans to use record keepers in the plan. Anna, can you go to the next slide, please? So what are a couple of things that the IRS looks for in an audit? Okay. There's three main things that I always see they look for in an audit. All right. And this is where I'm going to touch back on solo plans, one-person plans. You have a client, they set up a solo plan, they go to, let's say, Fidelity. And the client's like, hey, I'm going to do everything Fidelity and stuff like that. Fidelity gives them like a 2-page adoption agreement to set up the plan, and then they're good. Okay. Well, the problem with that is IRS has amendments and restatements that need to be done all the time in retirement plans. If you're familiar in the retirement plan world, there is the Secure Act 2.0, which needs to be done before December 31st of 2026. And that's a 3 or 4 page amendment that goes over like raising the force out limit from $5,000 to $7,000 and a bunch of other things. The big one is Cycle 4 restatement, which next year or in 2028, you're going to have to redo your entire plan. Okay. And in a solo plan, Fidelity won't come to you and say, hey, you know, you got to do this amendment, you got to do this document. Okay. They also won't tell the client that when they got to start filing 5500s on the plan. Familiar with retirement plans, you know that if you have over $250,000 in assets in a solo plan, you got to start filing 5500s. I probably had 10 people call me last year that said, hey, my solo plan's at $750,000 now. I haven't done 5500s for the past 4 years. What do I do? I just found this out from my accountant. That is why you hire a TPA. Solo plans with our office, we're doing the amendments, we're doing the restatements, we're communicating that stuff. We're going to you guys as the financial advisors with your clients every year and saying, hey, what is the asset level at? Maybe you rolled a couple $100,000 into the plan and it put them way over the limit and things like that. We are doing that stuff. That is probably the biggest thing the IRS nails people on is plan documents and amendments because they're not being properly done or they're not being kept on record and things like that. It's the absolute number one thing. Okay. The other two things that they're looking at is contributions and distributions. So contributions, as I mentioned before, they want everything to tie out. They want to tie out what was deposited to the plan versus what is on the 5500 versus what was withheld from somebody's paycheck. Okay, all that stuff has to tie out. That's where your TPA is extremely valuable. All right. Distributions. Retirement plans are on a pre-tax basis. Somebody takes money out of a plan, obviously should pay taxes on that money when they take it out. 20% at least for federal. State could be something, under 59.5 could be something. The IRS wants all the backup on the distributions. Okay. That's why it's very important to use a record keeper because the record keeper does all that stuff. They do the tax withholding. They do that. Okay. I've had a couple instances where a client has had a brokerage account in the retirement plan. The employee called up the broker and said, hey, I need $10,000 out of my account. Broker looks at the account, says, oh, it's under this person's name, mails him a check for $10,000. Okay. Super bad, super wrong. Okay, because tax withholding needs to happen, forms need to be signed, trustee needs to sign off on it, but I have seen it before. Okay, record keepers, the client has to sign off on it, the TPA has to sign off on it and verify the vesting. There's a backup, there's paper trail there. Okay, that's why, you know, we encourage people to work with Emeritus because they have all those systems in place. They do online distributions, they do paper copies. Great system to work with. I get a portal every day as to what distributions that need to be done. We have somebody in our office that just does distributions and loans and plans, and that's it. And that is a big thing that's going on in our office, believe it or not, all the money going in and out of the plan. Got to keep that stuff, records of all that for the audit if that ever comes up, because the IRS wants to make sure that they got their tax revenue with related to the plan. Okay. Anna, can you go to the next slide, please? Okay. Why is a plan audit is something I mentioned before. Okay. Sometimes it has nothing to do with the 401k plan. The client that we had a approval from the IRS from their audit because everything went fine. They got audited because they did not file their corporate tax return for 3 years. And the IRS said, or the client said, well, the IRS owes us money, so we weren't going to file our return until we got our money back from the IRS. Good luck having that conversation with them, okay? Because the IRS, I believe they kept ignoring the IRS, and the IRS said, fine, we're going to come in, we're going to do a DOL audit, we're going to audit your retirement plan, we're going to audit your corporate returns and things like that, okay? So a lot of times it has nothing to do with the 401k plan. It's something else, okay? It could be, and I have that under number 4, it could be in a complaint from an employee, okay? If they're not offered the plan, and this is something I always emphasize with advisors, it is not the employer's responsibility to offer the plan to the person and say, hey, I offered them the plan and they didn't want the plan. The IRS comes in and audits the plan. They want to see enrollment forms on every single employee that's eligible for the plan, whether they contributed to the plan or not. I just went through that in the audit. So they should have something signed off by an employee. Hey, we offered you the plan, but you did not want to contribute, okay? It is required that you get a sign off by your employees. I am always emphasizing with clients, make sure you have signed enrollment forms on all your employees and beneficiary designation forms. Very important. Not to go down a rabbit hole, but beneficiary designation forms are super important because I've seen a lot of problems where people have not filled one out, they're not married, and there's contention going on, and it goes to probate court and messes upon messes. So very important as the financial advisors that you guys are doing that. And offer to have, you know, a periodic meeting with the employees. We're there to provide eligibility lists. We're there to provide enrollment forms. Emeritus has got a great enrollment package for the employees. They can do online enrollment or PDF forms, things like that. And then I'll touch on 2, 3, and 4 real quick. So 2 is maybe the 5,500 wasn't completed properly, or the numbers didn't add up on the financials on the 5,500. The IRS would probably raise some questions. If the client ignores that, then they probably come in and audit the plan and see what's going on. Late 401k deposits. You'd be surprised how often late 401k deposits happen in plans. But I am trying to communicate with advisors. There are absolutely solutions out there. A lot of times advisors will sit there and say, well, yeah, I do the 401k plan with the payroll company because they do all the deposits and everything. Well, the service is horrible, number one. And number 2 is there's a lot of solutions out there called 360 payroll and 180 payroll where they will integrate all the deposits, and it's the same exact system. And a lot of times it's cheaper. You know, there's a company we work with that does charges like $40 a month to do the payroll integration. The client doesn't have to do anything. Just because you think bundled is easier, the retirement plan world has changed a lot over the past 5 to 10 years, where actually bundled is not easier, and usually it's more expensive. Okay. And then number 5 is incorrect count on the 5,500 for the participants, meaning you have over 100 account balances in the plan. You're still filing a 5,500 SF, and you are supposed to be doing a straight 5,500 with the accountant's audit. They might come in and want to audit the plan for that reason. Okay. Anna, can you go to the next slide, please? So just to do a little recap, and then I'll open things to questions, is number 1, don't ignore anything you get from the IRS. I think that's a common thing out there, whether it's related to the retirement plan or not. You're just poking a bee's nest if you do that, and you're not going to get a nice case officer. The more you are receptive to them, and sometimes it takes a while to get the information, the more you communicate with them, the better shape you're going to be. Very important. Number 2, use a TPA, okay? It is very important in these situations to use a TPA. Use a good record keeper like Emeritus so the client can get the reports, they can get online. The participants have a really good experience related to the retirement plan, not just from an audit perspective, but from a plan operational perspective too. You know, the client has a business to run. I love retirement plans, but I also understand that's probably 1% of their life and their business is the retirement plan, and they don't want to be sitting there having to deal with distributions or going on a website or problem with a contribution. You want to have a good solid record keeper you're working with, and a good solid TPA that can help them when they have those questions. If we have a client that has a question with the Emeritus deposit system, call us. We'll do a Zoom demo with you. Don't assume you have to get on the phone and call somebody and sit on the phone for 2 hours. We are there to help with regard to that stuff. And number 3, use a record keeper. I've said it a bunch of times during this call. Record keepers are very important if you have plans that have employees. They provide the fee disclosures. They provide the QDIA, the Qualified Default Investment Alternative Notices. A lot of times I've seen brokerage accounts, advisors that are old school keep parking money for employees in cash when Department of Labor wants them to be in a Qualified Default Investment Alternative, which record keepers take care of all that stuff. You guys want to go out and sell business. You don't want to have to deal with administrative stuff, okay? That's why we're here, is so you can say, hey, Mark, hey, Dom, we got this plan we want to talk to. You know, can you get on a Zoom with them? We set up the meeting, we do the call, we go over the plan design, things like that. And then you guys can go in there and sell other things like, you know, life insurance, things like that, other things to the owners of the company and stuff. And we're dealing with the administrative stuff. I hear it a million times from advisors. They don't want to deal with that stuff. And that's why some advisors don't want to do 401k plans. That's why we're here, is to help with that stuff. Okay. Yeah, I got a couple minutes, so I was going to open things to any questions anybody has related to audits or anything retirement plan related. I've tried to get everybody's information. I reached out to everybody, I think on LinkedIn, so you have my contact information. You have a little bit more in a bio of our company and stuff like that. But anything you guys have questions with, you can fire them out.
Thanks, Mark. While I'm waiting for people to think about questions or anything like that, I mean, I think this is a perfect example of the value of a TPA right here. You're never in a million years going to get someone as knowledgeable on this type of information and how complex it is than someone like Mark, who does this morning, noon, and night. So I definitely encourage you to connect with him. And Alonzo, it looks like you have a question, so let me unmute you real quick here.
Yeah, how's it going? In regards to, I guess I can lower my hand now. In regards to all of this, the new, I guess, thing that's happening with annuities being able to be added or implemented into 401ks. Can you kind of speak to us a little bit about that? And then number 2, how would that affect, I guess the record keeper would probably be the best thing there, but how would that affect audits? And obviously, you know, our role, like you said, as the advisor or the agent is really to just get out there and sell business. Is there like a resource of information that we can have, or like a bullet point sheet that we can kind of look at to be able to explain that to potential clients?
So when you're saying an annuity, are you saying an annuity inside of Emeritus or something outside of the Emeritus record keeper from that perspective?
Well, preferentially both, but I guess in this situation, the Emeritus product.
I mean, from my perspective as a TPA, as long as it's registered to the plan under the plan tax ID number, it's valid to be used as a plan asset. We have some clients that will have an account with Emeritus, like their business, and then Emeritus has a brokerage option that you can use. Is it, Dom, is it TD Ameritrade you guys use for the?
Yeah, I think it's TD Ameritrade, and we might have one other option. Anna, do you know? I think we have one other one too. Do you know off the top of your head?
I do not know off the top of my head. I'd have to look.
It's something I don't encounter a lot here, but Mark, you can chime in on that too.
So you could, the annuity stuff you can definitely do. I mean, we're seeing it more and more. The only thing is, you know, obviously annuity might have surrender charges, things like that. You just need to be careful. And sometimes, because I'm dealing with this on another plan, you want to check at the back end of the annuity contract that when you want to move it, that person retires or they leave the company, what's going to happen? How does that money get transferred? Because a lot of times people want to do like in-kind distributions or in-kind undercharge, so the money's got to be there enough. So that's the only thing. I can definitely do it in the plan, not a problem. I would definitely say to let me check it out if you want to put it in there. But I would say from my experience, always check at the back end of the contract and see what happens when, you know, that contract needs to be either transferred or cashed in.
Thank you.
Did that answer your question?
Partially, yes. I guess part of it is, and I think you kind of opened a little more for me in terms of, because generally, like you said, the annuity is specifically with the individual. So I'm wondering, how would an annuity be implemented across, like, would it be something that, you know, there's a requirement of participation for the group, etc., or is it like, you know, Bob can have an annuity in his 401k, but John doesn't?
Well, it would have to be offered to all the employees in the plan, but it's not like life insurance where it's required if you're going to, you know, write a policy for somebody and stuff. So the rule of thumb in retirement plans is if you're going to offer a benefit to one employee, it's got to be offered to everybody on the investment side. You can't just say to the owner of the business, hey, we're going to set up a, you know, and the employees. So normally what happens with Emeritus, for example, is you have an enrollment form or change of election form. It has all the funds listed on there if you're doing this with Emeritus. And if that annuity is available through Emeritus, they will have it on there, and then you'll select that. And then when the money is deposited into the plan, they'll allocate it to the different investments that way, okay? If it was going to be something outside of Emeritus, that's a little bit trickier. And we might have to kind of check that out a little bit to see, you know, what needs to be done compliance wise. So my thing is always try and keep it within the record keeper. If you want to do something outside of that, it's usually a case specific need to look at first before we decide we're going to go down that road.
And then I guess the next one, would the contribution limits still be the same?
Yes.
Okay.
Yep.
Thank
Nothing
you.
changes with regard to the, and if you have life insurance in the plan, there's limits as to how much the policy can be versus contribution and things like that. But with an annuity, the limits are the limits. Nothing changes with regard to that.
Thank you.
Any other questions anyone had? Okay.
I guess I do. I don't mean to be the squeaky wheel.
That's okay.
But I wonder, in regards to adding the annuities to the 401k, how different from like a 412(b)(3) that would be.
I don't get involved in 4B12(3) plans, so I'm not sure what the comparison would be. I'm just in the 401k pre-tax deductible stuff, so I don't know. I mean, it's something where from the retirement plan perspective, from my perspective, it's really just another investment that's in the plan. You know, if it's just like a mutual fund or a stock or something like that, it's just like any other investment in the plan. I know like Emeritus has like a stable value account. Okay. We have some clients that will transfer money into Emeritus, and they'll have money in like a stable value somewhere else. And then there's surrender charges and stuff like that. That's all stuff you got to kind of look at and stuff. But for your question, if it's a straight out annuity, it's treated like any other investment that's in the plan. There's no different. Contribution limits are the same. You can put as much money as you want in there. Nothing really changes with regard to that. I just don't know if Emeritus offers that product. I know they have like stable value and stuff like that, but specific annuities, I don't know. I mean, that's something you'd have to explore with Dom and Anna a little bit more.
Yeah, we'll have to kind of go back and look on that. I don't know if we're referring more towards like guaranteed income options. I know that's something that we're still kind of ironing out as an organization. But Alonzo, we'll go back, Dom and I, to gather some more information on that for you.
Thank you. Yeah, I want to be.
And Alonzo, if you have specific like ones, I can always look at it if it's a certain company or something like that you kind of work with in this space. You could say, hey, it's this company, this is what, and shoot me over an email, and I can look into it a little bit further for you.
Well, I'm also looking at because recently rolled out was a lot of PEP or pooled employer plans.
Yep.
You know, and I have some local businesses near me, but they're all small, and you know, the
Mhm.
implementing of a 401k can be a heavy burden, both you know, financially and administratively, especially for smaller businesses. But if they can pull together, I'm just you know looking at new ways to drum up business. Right, I'm
Yeah.
an ultimate salesman.
Yeah,
Right. No, I get it.
absolutely.
In the PEP, there's definitely a place for it in the industry. That is what and work with one company to do the whole thing. So, you know, Emeritus they have a very good PEP program where they do the administration and the investments and everything. And in that situation, I've seen it before where it just makes, I've recommended people to do PEPs and I don't deal in that space. But you know, there's nothing wrong with that, with going down there with these small businesses and stuff. You're just, you know, you're giving up plan design and plan eligibility and things like that. You're going into a certain program and you can't really do things out of the box, but there's definitely a space in the industry for it. So there's nothing wrong with that.
Thank you.
Yeah, Alonzo, I'll happily follow up with some more information about our pooled employer opportunities here at Emeritus as well.
Thank you.
Mhm.
And then Anna, can you just flip to the last slide because it has my contact information in there?
Yes.
But I also,
absolutely.
as I said before, I reached out to everybody on LinkedIn, so you have my contact information that way if you want to connect. You know, and if any questions come up, just shoot me an email, give me a call, whatever.
Yes. Thank you, everybody, for joining us. I don't know what happened to Dom. I know his technology has just been absolutely kicking his butt today. So I will go ahead and wrap this up. Again, thank you all so much for taking the time to listen to our expert, Mark, about audits. And we sure hope to be in contact. We'll follow up with you all with an email. And please do not hesitate to reach out to us in the meantime if anything comes up. Thank you all.
Thank you. Have a good day.
Thank you.
Bye.
Thank you.
Thanks. Bye,
Yep,
guys.
bye. Bye.
All right, ladies and gentlemen. So that was, and I'm streaming live to TikTok and YouTube here. So I'm going to put you guys back on my YouTube screen. Let's see what my camera looks like. Yeah, I can be off camera right now. My barber wasn't in yesterday. Michael Clark, you just missed it. I was doing some communication with the TPA, asking some questions about the annuities being able to be put into 401ks, pooled employer plans, etc. There's not going to be a bunch of craziness. I did put together a little something of a script for my audience here, just to kind of speak about the 401k versus the 412(b)(3), which is a fully insured defined benefit plan. So I will be talking about that a little further, specifically on my YouTube channel. So if you guys here on TikTok are unaware, just because it's a lot easier for me in screen share, etc., to do this via YouTube. And I guess it doesn't matter. I can show it to you guys via TikTok as well. Let's do it. All right. So, like I said, I've written out a script here. And so I explained that I want to do a live stream and discuss a 401k versus a 412(b)(3) plan, the differences, advantages, and disadvantages of both, who they're for, and how to work with me and a TPA to administer this for their business. So I had to write me a template and a script. And the first thing that AI does, and again, this is why when you're using AI, if you don't understand, if you're not a subject matter expert, then you could put, for example, is Rocks on Pizza good? Because a friend of mine did this. There was a place called Rocks on Pizza, and he asked if Rocks on Pizza was good, and AI was like, yeah, Rocks on Pizza is a good idea. But he didn't mean literally rocks as a topping on pizza. He meant the restaurant Rocks on Pizza. So if you're not a subject matter expert, AI will generally totally obliterate your plans and won't be helpful at all. However, if you are a subject matter expert and you're very hyper specific about the prompt, you'll get stuff like this. So it literally says, this is a high level advanced planning topic, perfectly suited for business owners looking to move beyond standard advice. To make the stream visually distinct, ensure your streaming software is loaded with your signature green and black or deep navy and gold branding assets. Those are some of the colors that I use in my branding. Green and black for ADH Wealth Solutions and gold and blue for ADH Wealth Solutions. Wearing your custom window pane checker blazer with your RFC lapel pin will complete the authoritative look. So first, if we go here, it says to look at you guys and say, hey, welcome in. We're talking about what separates a bunch of stuff from bullshit to real advice. Most business owners are told to open a 401k set and call it a day. But if you're highly profitable, older, and need to write off hundreds of thousands of dollars this year, a 401k isn't going to cut it. So today we're putting a standard 401k, which is tax code, up against the heavy hitter, the 412E3 fully insured defined benefit plan. What's going on, lovely days? The judge has been removed from Carmelo's case. Great. Whether the judge is removed or not, really, there's nothing we can do about it. We can have our opinions, but that's not going to have an effect on our day-to-day life. So, this is going to tell you exactly who you should use, exactly how my team and a third-party administrator can structure these for you and your business, right? So we're going to start with the 401k. Right, which is a defined contribution plan. So ladies and gentlemen, if you don't know the difference between a DB or a DC plan, defined contribution is what you're familiar with when it comes to, let me check the YouTube here, see what's going on. No comments. Okay. Defined contribution is what happens when you are defined in what you're contributing to your retirement account. So for example, a 401k defines specifically how much money you can put into your 401k, which would be $24,500. That's defined contribution. Defined benefit means you are going to get a definitive amount on which you will receive in retirement. So you work for us for 20 years, we're going to guarantee you $12,000 a month for the rest of your life, right? So defined contribution versus defined benefit. Defined contribution, meaning I want to know how much I can contribute towards my retirement. Defined benefit, I want to know how much I will actually receive during retirement. Most people would really prefer, just like when I sit down with them and talk about life insurance, they want to know, well, it depends on what I'm going to get. Yet they never consider that when they're looking at their retirement account. They just know, oh, I got me a 401k. Well, if you don't know what you're going to get, you just know that you can contribute. That's not always beneficial to you because you don't know what you can bank on. For example, if you have a salary and you know that working 40 hours a week, you're going to receive $1,000 at the end of the week, you can rest on that. Moffitt, what's going on? I just got off of a Zoom meeting with a TPA, so now I'm talking about 401ks and the 412E3. So as you see here, it says the baseline. So you start with the 401k, which is a defined contribution plan. You know exactly what goes in, but you have no idea what the ultimate benefit will be when you retire because it's tied to the stock market. So again, as I said, defined benefit versus defined contribution. Defined contribution, you know exactly what you're putting in there, but you don't know exactly what you're getting out. Defined benefit, you know exactly what you're getting out. And because you know what you're getting out, you're also going to know what you're going to have to put in. So now what are the advantages to a 401k defined contribution plan? Well, there's flexibility. You can adjust your contributions year to year. So if your business is down, you can actually pull back your contributions. There's widespread understanding. The employees generally know what it is. Not really, but they're not going to ask a shit ton of questions. There's lower administrative costs, so it's relatively inexpensive to run. Ironically enough, nobody's watching on my YouTube. That's crazy. I don't even know that I mean, I'm not at the moment. I'm going over 401ks right now. I just left a meeting with a TPA on a Microsoft Teams meeting who was explaining 401k audits and how we can be there for our clients, which is not exactly studying for the 65, but in essence it is because one of the things that I realized about credentials in our industry, I actually had this occur with a colleague of mine yesterday who is extremely proficient in life insurance. And I was explaining, you know, what's so funny is that inside of these exam manuals, there's so much information we don't use, like per stirpes and per capita. And he was like, per stirpes? I've never heard that. And I was like, yes, you did. It's literally in the life insurance exam manual. So what are the disadvantages to the 401k? Well, with catch-up contributions, even with catch-up contributions, you're capped. If your business has an extra $300,000 in profit that you want to shelter from taxes, the 401k mathematically cannot absorb it all. And then another disadvantage is market risk. So you and your employees bear 100% of the investment risks. If the market tanks right before your retirement, the account balance tanks with it. So now there's an interaction phase. Like I said, ladies and gentlemen, I had AI write this script for me, but I go off script. I literally just put in there what I wanted to talk about because, you know, I jump around a lot. Actually, a young lady who was watching another one of my live streams asked that. So it tells me to pause and ask you guys to drop a 1 in the chat if you currently have a 401k for yourself or your business, and a 2 if you don't have any retirement plan set up yet. And then I'm going to, I guess, read a few names on the screen. They can, AI is amazing. It'll literally tell you how to run a live stream. Isn't this amazing? Ladies and gentlemen, do me a favor and tap the like while we're at it. I'm going to tap the like too. If you're in here, if you find this valuable, right? I just had someone who came in and told me about the Carmelo Anthony judge. And while that's great to know, what does the judge on Carmelo Anthony's case have to do with you or your children? Or your income? Or your effect on the judges? Other than nothing, right? But this has some actual effect on you, especially if you're a business owner or an entrepreneur. How many people have a YouTube, Facebook, Instagram, TikTok page that's monetized and now you have an LLC? And we're talking about politics and all these damn business numbers are in here. Oh, businesses are up. No, people are filing for businesses, but the IRS sees a business that's been in business for 5 years and has not been profitable for 3 out of those 5 years as a hobby. So maybe you should learn some of this instead of bullshitting back and forth worrying about Carmelo Anthony's case. Or if Donald Trump is playing checkers or chess. Basically, you're playing checkers because you're fucking around on this app, escaping. So questions of the audience. For those of you with highly profitable years, have you ever felt frustrated hitting that contribution ceiling in your current plan and having to pay taxes on the rest? Now, this also created a visual for me. So now let's talk about the solution for that exact problem. Something called the 412E3 plan. Now, this is a defined benefit plan, but as you can see, it's fully insured, right? So people who say there's no room for cash value life insurance obviously are not working with highly profitable business owners as they say they are. Or they're not acting in that fiduciary capacity that they say they are, looking out for the best interest of their client, especially when they don't even know about this. And this is a tax code. I want you to ask your CPA about a 412E3. Shit, I just asked the third-party administrator who handles many of your 401ks and solo 401ks. Hey, what about the 412E3? Now, he doesn't administer 412E3s, but you generally do need a TPA who can administer 412E3s, and he was unaware of the 412E3. Interesting, isn't it? So, again, I was just discussing the defined benefit versus the defined contribution. AI actually broke it down for me very great. Early on, it said the 401k is a defined contribution plan. You know exactly what goes in, but you have no idea what your ultimate benefit will be when you retire. That means that's defined contribution. Defined benefit plan, right? So it's a defined benefit plan, but it's fully insured. That means the ultimate retirement number is guaranteed by an insurance company. Now, because the IRS requires these plans to assume a very conservative guaranteed rate of return through life insurance and annuity contracts, the amount of money that you are legally allowed to contribute and deduct from your taxes is massive. So let's look at the advantages. Like I said, I want to look at the advantages and the disadvantages. What's going on, Vesta? So the advantages are unrivaled tax deductions. You see, when you're looking at wealthy individuals and business owners, they're not always concerned about, oh, I want the returns. Like you get herded into from many of these quote unquote financial professionals online. Oh, I could get you a whole lot of return. So it sounds great. They're telling you can earn this money, but then the idea is to earn it to be able to spend it. See, they teach you about the accumulation phase, but not the distribution phase. And obviously, this is all off of script, which I have this script here, so I will continue. Thank you for the likes. Ladies and gentlemen, please continue to tap the likes and share this out. People need this information. Again, no disrespect to the young lady who came in to explain to me they just changed the judge or the judge all day. CJ, what's going on? I'm talking about 401ks versus 412b3s. I just got off of the live or the Zoom meeting earlier. So I wrote a script here. And basically, like I said, I went into AI and I said, I want to do a live stream and discuss the 401k versus the 412E3. And the reason I'm talking to you about this is because you're familiar with it. The differences and the advantages, And so now it broke it down, but I'm breaking it down further. So this is actually a visual for you, right? And so if you'll see here, to help your audience visualize the massive difference in contribution limits before you break it down verbally, you can use this interactive comparison tool on screen. So if you'll see here, it starts with the 401k plan. The max annual contribution is $76,500. Liddell, what's going on, right? However, with a fully insured defined benefit 412E3 plan, right, you can contribute $278,972. You can actually contribute more. I know an attorney who contributed substantially more. If I go to YouTube, actually, let's go to YouTube and let's type in 412E3, which there's very little information about this out there. 412E3. Let's see. 412E3. Using the 412E3 tax code for self-employed and closely held business owners. Intro to section 412E3. Taking the first step towards buying. That's buying a house. Ask ChatGPT how IRC 412E3 works. 412E3, right? Now, here's what's funny. Just like when I did the collateral assignment, nobody knew what it was, and now everybody's talking about it. Next will be the 412E3. Everybody will be talking about this next, but nobody knows how to actually use it. Empower your retirement with the 412E3, right? These videos have very few views, right? How one doctor saved $1.5 million a year in taxes with a 412E3 plan, right? The retirement, the $3 million retirement strategy they hide from you. So this guy is Todd Villarubia. I believe he's an attorney, right? Wealth Planning Law Group, right? So Todd Villarubia has 30 years in-depth experience with complex challenges regarding familial and individual wealth, right? He's talking about this. I'm talking about this. Now, there are very few views on his video. When I talk about the 412E3, not many people know about it. So let's go back to the visual here. Okay, so let's go back. She says, I came to realize that too many people are house rich, but cash poor. Absolutely. So let's look at the advantages of the 412E3. So depending on your age and income, contributions to a 412E3 can be 3 to 8 times higher than a traditional 401k. So imagine in 1 year, you can put 8 times as much as you would in a 401k into a 412E3, which is just life insurance and annuities, the products that everybody tells you is garbage, right? Now, yes, this is not for your everyday American, but right now I'm not talking to them. I'm talking to business owners. And guess what business owners are? Everyday Americans, right? The other advantage, guarantees. Who doesn't like guarantees, right? Oh, well, you know, if I put my money into the stock market, it could get 10%. They cannot guarantee you this 10%. So yeah, historically, the S&P 500 returns 10.3% year over year. See, they don't tell you what it returns over the course of a time horizon. And after fees and drag, according to Dalbar, it returns 7.4%. But you and me and John and Bob are not named S&P 500, and we're not returning year over year. We're returning over a time horizon, which is average 20 years. So 59.5 is really where we take that money. And we're averaging 5 to 5.5%. Not to mention taxes and drag. So guarantees, zero market risk. The benefit is locked in. So fast tracking, you can fast fund your retirement. If you're 55 and want to retire at 65, this plan allows you to cram a massive tax deductible contributions into a 10-year window. Now the disadvantages, commitment. This is not flexible. You must make level annual premium payments. If your business cash flow is volatile, this will choke your business. No loans. Unlike a 401k, you can't borrow against it. Lower yields. You're trading high market returns for guarantees and massive tax deductions. So now, who is the ideal candidate, right? Because this is not for everyone, just like an IUL is not for everyone, just like buy term, invest the rest is not for everyone. And to be quite frank, buy term and invest the rest when there are things like self-directed IRA real estate. So the federal government realizes that one of the fastest appreciating assets is real estate. Okay, so it says here, so who is this actually for? The 412E3 is a scalpel, not a Swiss Army knife. It's designed for older business owners, 45 plus. The older you are, the more you can legally contribute to hit the target benefit. Number two, high stable cash flow. You need consistent, predictable profits to fund the retirement premiums. But many businesses are burning through money, and every year to get a tax deduction or a tax advantage, right? They are, real estate can be a liquidity risk, but there's risks in everything, right? Sequence of return risks, timing risk when you're, if you're retiring and right when the market drops, well, that's great. Now what you're going to receive is not what you thought. And small employee headcount. Because you have to fund the benefits for eligible employees, this works best for solo practitioners, partners, or companies with smaller, younger staff. Essential, I'm glad you said that, because everybody is apparently the best realtor on earth, and they sell houses in 30 days or less. When the average time on the market is about 6 to 9 months, right? Yes. Do houses sell quick? Sure. There's a house you can put on the market and it'll sell tomorrow. That does happen. But there are way many more houses, and this is why you have what's called expired listings. And I'll show you guys that, because why the fuck not? I used to do real estate. My Google Drive is about full here. Let's see what's shared with me, right? Yeah. Shared with me. Right? Did they stop sharing it with me? They may have stopped sharing it with me. Right? What does this say? Expireds, right? So expireds means that these are listings of houses. There's 178 pages, right? These are listings of houses that people were selling in New York, right? And they didn't sell, so it expired, right? So generally you get anywhere from 6 to 12 months to sell a house. I have a file here with 278 pages of houses that didn't sell, meaning the listing expired, so they didn't sell in a timely fashion. So absolutely, EA. And ladies and gentlemen, I will open this up shortly once I finish this little scripted thing I have here. So now it says to interaction pause. So I know we just covered some heavy financial architecture It says, what are the questions do you have about the differences between the market risk of a 401k and the guarantees of the 412, right? And then it says, answer 1 to 2 quick questions from the chat. And then it says, someone asks if you can have both. And the answer generally is yes. You can retain a 401k for employee deferrals while adopting a 412E3 to maximize your own deductions. But the rules are complex, which brings me to a final point. And this is from Port Brown. Let's open this in another tab. Let's go ahead and open this in another tab. So Port Brown is accountants and advisors, right? So it says the 412E3 plan is an overlooked retirement savings options. Let me look. What's going on, Complex? I am streaming both to this and my TikTok. And I am seeing that, you know, with the low views, if I was busy talking about, like I said, no disrespect to the young lady, but someone came in, oh, the judge for the Carmelo Anthony case stepped down. Great. What does that have to do with any of this other than nothing? What effect can you and I have talking about the Carmelo Anthony case other than nothing? We think, oh, they heard the social media. Listen, they don't give a fuck about social media. They're going to do what they're going to do, right? But this is an accountant firm. This isn't my information. So this is, oh, let me share this on my, hold on, let me share this other screen. Remove, let me share this other screen on my YouTube. I'm just going to share my entire screen on the YouTube really quick. Right? But yeah, what does you and I talking about Carmelo Anthony's lawyer have to do with anything? So they updated this as of 2023, right? So unlike 401ks, which are defined contribution plans, which you heard me talk about that, 412E3 are defined benefit plans. This means that the 412E3 plan provide benefits under a formula based on factors such as the participant's compensation, age, and years of service, right? So for 2023, the annual benefit can't exceed the lesser of 100% of the participant's average compensation for their highest 3 consecutive years. So those pension plans that you be hearing the firefighters and police get, or the municipal workers, oh yeah, my top 3. Well, this is exactly that for your regular employee, or $265,000. Now, let's continue here. So you cannot DIY a 412E3. If you try to structure this without experts, it'll trigger IRS penalties. So here's how you work with me to get this done. We start a census and we look at your age, income, and your employees. Again, it's going to be for business owners 45 plus, right? You're generally doing way over $250,000 a year, right? So that you can obviously benefit from being able to stuff a shit ton of money. So from there, we coordinate with a TPA, or a third-party administrator, right? They're going to handle the compliance. They draft plan documents, and they prepare the Form 5500 filings, which is the tax return for your 401k plan. Meanwhile, I design the actual funding mechanism, selecting the precise guaranteed life and annuity contracts that fund the plan to satisfy the IRS safe harbor rules. If you're a high-earning business owner and you're tired of standard advice, you want to explore your business cash flow qualifies for a 412E3, you know how to hook up with me, right? So now let's look a little, it says an actuary. So no, the TPAs are a little different from an actuary. But let's look at this Todd guy, because he did a video on it. Anyway. Now, here's one thing we always talk about, right? There's a difference between tax avoidance and tax evasion. Avoidance is legal. Evasion, you go to jail, right? But we always want to bring down that tax liability, which is why we do things like a 401k, so we can bring our income tax lower. Well, if you're a business owner, especially if you're self-employed, then the 412E3 is absolutely something you want to do. Let's continue. His CPA kept pushing SEP IRAs and 401ks, but your CPA is supposed to be a tax specialist, right? So let's just Google 412E3, 412E3, right? I like to go to irs.gov. There should be a... Okay, so an IRC Section 412E3 plan is a fully insured defined benefit retirement plan funded exclusively through a combination of secure annuity contracts and life insurance policies. It provides guaranteed retirement benefits managed by an insurance carrier, bypassing traditional stock market risks. Let me just check the YouTube here. No volume. You guys can't hear me? Oh, you guys couldn't hear the YouTube, right? So now let's go to, irs.gov. Remember, when I bring you guys to websites, I don't bring you to bullshit. I bring you to .gov, right? So we know about Internal Revenue Code 401k, but we don't know about Internal Revenue Code 412E3. Life insurance and annuities. The things everybody tells you go to the stock market because you're going to get 10%. They are not guaranteed, right? Let's go here. Before the Pension Protection Act of 2006, these plans were known as 412I plans and were established pursuant to the rules of Section IRC 412I. The former IRC Section 412I provisions were retained under the PPA of 06, but were relocated to IRC Section 412E3, effective for plans years beginning December 31, 2007. Regulations were not updated after the enactment of PPA 06 and remain in Treasury Regulation Section I-412I, Section 1.412I-1. IRC Section 412E3 plans are exempt from the minimum funding rules of IRC Section 412 pursuant to IRC Section 412E2B. Right? So, ladies and gentlemen, this is not me blowing smoke up your ass. This is www.irs.gov. Like I said, I go to .gov. When I'm talking about life insurance, I'm talking about it from the perspective of absolute credible sources. Right? So, let's look at some 412E3 requirements. To qualify as an IRC Section 412E3 defined benefit plan, a plan must also satisfy the following requirements. Plans must be funded exclusively by the purchase of a combination of annuities and life insurance contracts or individual annuities. So guess what can't go in there? Term life insurance. Guess what else can't go in there? IULs. You can only put traditional annuities and traditional life insurance, whole life insurance. Now, my favorite product is an IUL for most individuals. However, if you are enjoying this, ladies and gentlemen, make sure you follow me on both platforms. Let them know. .gov, bro. .gov. Right? I go to .gov. Let's see. Let me play a little more of the video here. And let me know if you can hear it on YouTube. So Miguel, 412E3 plans is what I'm talking about. So someone like yourself would probably want to rock with me and get a 412E3 because yes, there are a lot of people who definitely don't understand this, right? So I decided to go to irs.gov and talk about an IRC 412E3, right? You know about IRC 401k, not you specifically, but most individuals. Let me see. No sound in the video. Okay, I got to figure out how to get this to work. Because I know you guys can hear it through the TikTok. Let me move my mic on YouTube closer. Oh, shit. Let me, and I just knocked down my mic off my desk and get my setup. I had to come back to YouTube, guys. I've been neglecting y'all. I've been over on TikTok. There's another app that I'm using by a brother who created an app via social media called All of Us. It's supposed to have less censorship. I can't stream directly there yet, but I will. Let me play a little more of the video. Hold on. Let's go back and start again. I'm going to do like this.
Planning, nothing fit.
Hold on, let's do it.
Michael had spent 30 years as a doctor with a private practice. The business was successful, the income was solid, but the taxes, brutal. And
now, if I go back to my script here, let's take a look, right? So I just showed here, right? Annual income of 250,000, corporate tax rate of 25%. The business owner age, let's say, is 55, right? On the 401k, he's saving $19,125 in taxes, right? On the 412e3, he's saving almost $70,000 in taxes, which is actual money kept in your pocket. That, unlike the 401k, remember, that's tax deferred, right? So you're going to have to pay income tax on that. Same here, but again, you're still more beneficial because if you access it through a loan on a life insurance, loans aren't taxable. So again, a lot of financial professionals will tell you about accumulating, but they won't teach you how to spend the money, right? Let's go here. So we're just talking about the 412 and the 401k, right? Let's look at the advantages. Remember, I mentioned defined benefit and defined contribution. Defined contribution is the 401k, right? Meaning you know exactly what goes in because defined contribution, but you have no idea what the ultimate benefit will be, right? Whereas a 412e3 is a defined benefit. Defined benefit, meaning you know exactly what you're going to receive when you receive it. Let me just see how we're doing over on the YouTube. Okay, I'm going to start playing the video again for us on YouTube and TikTok.
Michael had spent 30 years as a doctor with a private practice. The business was successful, the income was solid, but the taxes, brutal. And when it came to retirement planning, nothing fit. His CPA kept pushing SEP IRAs and 401ks that barely made a dent. And Michael...
Now, his CPA, remember, his tax advisor, everybody goes to their CPA for the tax advisor. I am on irs.gov. 412e3 is a fucking tax code, just like 401k. Yet, these tax professionals and your CFP, who's supposed to be your fiduciary, and your attorney who has a fiduciary obligation, and your CPA who has a fiduciary obligation, yet they diminish the insurance agent. Oh, does the SEC look at you as a fiduciary? Yet, sitting right here is a product that you don't get spoken to about as a business owner. Ladies and gentlemen, if you're in business on YouTube or TikTok, I paused the video. If you're in business on YouTube or TikTok, put a 1 in the chat if your tax professional has ever mentioned a 412b3 plan to you. I want to see something. Put a 2 in the chat if this is your first time hearing about a 412b3. Now, again, the 412b3, you got to be pulling 250,000 or better. You generally want to be, I'd say 40 and above. I wouldn't say 45. Right? But again, this guy just said that his accountant, let's go back.
CPA kept pushing SEP IRAs and 401ks that barely made a dent. And Michael knew he didn't want to park his future in a volatile stock market he couldn't control. That's when we showed him.
Well, then why do they talk about so much control in a brokerage account? There is control in terms of you deciding what you allocate, but you have no control over the outcome.
A 412e3 plan and everything changed. If you're a high income business owner, the traditional retirement vehicles like 401ks, SEPs, and IRAs simply don't move the needle.
So let me invite Eddie. Well, Miguel, I just saw you pop up. I want to invite you up if you're able, because I want to have dialogue with you guys, right? I don't want to talk at you. I want to talk with you, right? So I do want to have the availability for questions, right? So Complex said this is the first time he's heard of this on my YouTube channel, right? Because I'm here on YouTube as well. Miguel, how are you?
Hey, how's it going? I'm currently operating a motor vehicle and have some very interesting conversation going on here, so I won't be able to. But I need to support you, my brother.
Appreciate it. Appreciate it. Well, if you can and when you can, feel welcome to speak, but definitely, ride along. And class is in session.
Thank you.
So, ladies and gentlemen, I was just on a meeting with the TPA, and I asked them, hey, because as you know, annuities are now, not only are they being, were they allowed to be in retirement plans, and are they retirement plans themselves, but now they're being allowed to be implemented, visibility restricted, because it contains content, unoriginal content. All right, whatever. So they're restricting my live, ladies and gentlemen. Please tap that like so they unrestrict and share it to people, especially if you know people who are self-employed or business owners. Let me see if I can share this to No Excuses podcast as well. Boom, boom, boom. Everybody wants to be a business owner. Like I said, a young lady came in. Excuse me, came in today to tell me about the judge from Carmelo Anthony's case. And whilst, yeah, it's a great thing, I guess, that the judge has changed, what is that going to do for any of us? Right? So, they used to be 412B. Go ahead, Miguel.
I was just saying, I completely agree with what you're saying.
Yeah, it's going to do nothing for us.
Exactly.
Right. But yet these are the ones who are complaining and right now probably have 100 to 200 people in their live. But we get that with Anthony's stuff too, right, Miguel?
Yep. Unfortunately, you get everybody's attracted to the drama. When it comes to the educational part to it, nobody wants to sit there and learn because they feel like it's boring. Well, listen, that's why you are where you are.
Right. And again, these people who are in this guy's predicament, let's watch a little more. But again, like I said, nobody has been told about, again, this is irs.gov. Nobody's been told about a fully insured 412E3 plan. Right? So again, a fully insured, before the Pension Protection Act of 2006, these plans were known as 412I. Right? But these are fully insured, fully guaranteed retirement plans, right? So now you can actually put an annuity inside of it. You can offer an annuity as one of the investment options in a 401k. I probably wouldn't recommend doing that, but you can. Bro said literally nothing. Literally. Let's continue.
You're capped on contributions. Often the contributions to your employees exceed what you can put into the plan for yourself, and you're told to wait until 59 and a half to touch the money. Meanwhile, you're paying 6 figures in taxes every year and wondering whether your actual wealth is going down the drain to the IRS. The illusion of tax deferred is killing future value. You defer income today only to pay higher income taxes later.
Hold on, ladies and gentlemen. Now, guys over on my YouTube, you guys know I've always been talking about, hey, listen, would you rather pay a little more in taxes today so you don't have to pay it in the future? Because the reality is, in the last 40 years, have we seen income tax go up or down? We've seen it go up. In the next 40 years, do you think income tax will go up or down? And everybody goes, oh, it's going to go up. And so I say, then why would you today put money away that you'll have to pay income tax on in the future? well, the idea is that when I retire, I'll be in a lower income tax bracket. Well, yeah, you'll be in a lower income tax bracket relative to what the income tax bracket is at that period of time. However, if income tax keeps raising, even if you're at the lowest income tax bracket, if today, one of the higher income tax brackets is nearly 37%, in 20 years, if income tax goes up, now one of the lower income tax brackets will probably be 37%. Again, we don't know, but this is what these guys are explaining. Now, maybe, I don't have the presentation that is palatable. I understand that. I'm not everybody's cup of tea. But let's go back and see what he's saying here.
Value. You defer income is going down the drain to the IRS. The illusion of tax deferred is killing future value. You defer income today only to pay higher income taxes later when you can't deduct anything anymore and your income may still be very high.
Backdoor Roths are cool, but they, watch this. Where's my Gemini? I just got a great question about the Roth conversion and backdoor Roth. Please help me explain using a rich man's Roth versus the conversion or backdoor Roth and the tax advantages and the disadvantages of them all in my cadence. Let's see what AI says here. So I just typed that. Now, as we're going to get back to the gentleman's video. 1 second. I just want to see what AI is going to say here. I'm going to bring the video back up, YouTube, but I'm doing multiple things at once. So let's see what AI says here. I just typed this in here, and AI is searching the web for us. So it says, I just got a great question about Roth conversion and backdoor Roth. Please help me explaining using the rich man's Roth versus the conversion or backdoor Roth and the tax advantages and disadvantages of them all in my cadence. Well, it's still searching the web, so I'm going to let it do what it's doing. Whilst it's doing what it's doing, I will remove this from the YouTube, free up storages. Oh, I'm running low on storage space. Ha 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 ha. Let's share this with my YouTube audience. And let's continue here. Let's close that out.
Plus, you have no protection. These accounts are tied to the market and subject to complex distribution rules. Michael had $2 million in liquid assets and no true structure to protect or grow it on his terms. In the next few minutes, I'll show you how a little-known retirement structure called a 412(e)(3) plan helped Michael legally grow and protect $7.5 million of his wealth outside the market, shielded from lawsuits, and with major tax advantages.
So when we say shielded from lawsuits, that's one of the things I did. Okay, we're going to stop that. And let's edit prompt. Boom. Let's just do this. Take my cadence and update. Let's see if it updates now. Whilst that's doing its thing. So again, ladies and gentlemen, Rob, what's going on? I'm talking about the 412(e)(3 because I was on it with a TPA earlier who was talking about 401k audits. I wasn't hoping or looking for a product recommendation. Essential, I missed what happened there in regards to the product recommendation talk. Give me a second there. Ladies and gentlemen, hold on a second. I'm going to go grab something to drink. Hold on. EA. AI just finished my prompt. So let's share that with my YouTube audience as well. Running a live stream is hard work. So it says, here's a breakdown you can use to walk through these 3 strategies. When high-income clients ask about tax-free retirement vehicles, the confusion usually stems from mixing up IRS contribution limits with tax strategy. So the 3 tax-free vehicles. 1, Roth conversion. This is a tax maneuver, not a contribution. You move existing pre-tax funds like a traditional IRA or 401k into a Roth. You pay ordinary income tax on the converted amount in the year you do it, but all future growth and distributions are tax-free, right? But you took extra steps there, right? The backdoor Roth, a legal workaround for high earners who are locked out of direct Roth IRA contributions. In 2026, married couples filing jointly begin to phase out of direct contributions at a MAGI, or modified adjusted gross income of $242,000, not even accredited investor numbers. So you can't do a backdoor Roth if you're an accredited investor making $250,000 or more. The backdoor method involves making a non-deductible contribution to a traditional IRA and converting it immediately into a Roth. The rich man's Roth. This is not an IRA. It is a maximum funded essential planners. No tax guy should generally be good at recommending products because they generally aren't licensed to sell them. There is a guy who is now a CPA who just got his life license and got caught up in the bickering back and forth. But again, I dropped tax code to him. I was like, well, hey, tax code for IRC 401k. You should look at tax code IRC 7702, 412E3, 101, 72E, 72T, 7702. So again, the 7702 IUL is a maximum funded permanent life insurance policy, typically an IUL. By structuring the policy under IRC 7702 to ride the line of becoming a modified endowment contract, you minimize the death benefit and maximize cash value accumulation. The cash grows tax deferred and can be accessed tax-free via participating loans. He says, I meant my tax guy. He's big on alternative investments, not market-based products. Okay. So he's not one of those guys who's like, oh, just put it in the market. You'll get 10%. Because that is actually them shirking their fiduciary responsibility, because you'll get 10% is highly inaccurate and you can't guarantee that because the market is volatile and it's not guaranteed, hence why it's volatile and variable, right? Let me share the video back with my YouTube audience and we're going to get back into this video. Let's go back a little bit.
The market, shielded from lawsuits, and with major tax advantages. Hi, I'm Todd Villarubia, a 30-year attorney with a master's degree or LLM in taxation, and one of only
a 30-year attorney with a master's degree in taxation, right? So let's go back, right?
$7.5 million of his wealth outside the market, shielded from lawsuits, and with major tax advantages. Hi, I'm Todd Villarubia, a 30-year attorney with a master's degree or LLM in taxation, and one of only 100 board-certified experts in estate planning and administration in Louisiana. I am the founding partner of both my law firm, Wealth Planning Law Group, and our new fractional family office, Fountainhead Global. We help high-income entrepreneurs and professionals implement advanced legal, risk mitigation, and tax strategies to protect their income, build wealth, and retire with control. Michael was...
Now, hold on, because again, what you'll hear from a lot of insurance agents who definitely ain't going to be talking about 412B3 and likely won't even talk about it after they hear this, because if you think an IUL has a lot of moving parts, these complex tax strategies have a lot of moving parts. Let me see what I got going on YouTube. Rael, what's good, big brother? Right? And Rael, you already know, outside of just the 412E3, we've got what we're working on, right? on our side of things, right? So again, if we look at the strategy, you can maximize the cash value, and the cash grows tax deferred and can be accessed tax-free versus participating loans. Now, one of the fear-mongering tactics that people will use is, well, the life insurance policy, if you don't pay back that loan, is gonna fall apart. Well, here's the problem. Number one, we live in America. How many people have one of anything, right? You only got one set of eyes, right? Or two eyes, right? But you can only view one thing at a time. How many Americans have more than one television in our house? How many Americans have more than one computer? How many Americans have more than one cell phone? How many Americans have more than one pair of shoes? Yet when we talk about things like life insurance, you're only supposed to have one? No. See, wealthy people are getting these policies literally so they can pump up a bunch of money, have it grow, borrow from it tax-free, never pay back the loan, die. The death benefit pays back the loan. And they don't worry about that because they have other life insurance policies, which is why I say the wealthy insure one life around 7 times. Right? Now, let's look at some of the features and benefits. So feature, IRS income limits on a Roth conversion, none. Backdoor Roth, none. Rich man's Roth, none. Yeah, an S-block can be cool, but when you're looking at an S-block, you're looking at a loan-to-value ratio, right? So let's say you want to borrow $200,000 Essential Planners, right? And that's a great, Hannibal, what's good, brother? Right? So let's say you want to borrow $200,000, right? And in a brokerage account with an S-block, right? You need to have $1 million there, right? Because LTV, you got margin call risk. So your prudent advisor would never let you go anywhere above 30%. And on average, they're going to do 20%. So you need to have $1 million of liquid capital and you can only access 200,000. On the flip side of that, in a cash value life insurance policy, all you would need is $225,000 liquid capital or cash value in your policy to be able to borrow $200,000. Which would you rather have? $800,000 tied up that you can't do anything with, or $25,000 tied up that you can't do anything with? Right? Because you'd have to have that $1 million to have that 20% LTV. Now, you understand this, Essential, what I'm speaking, but I want to make sure that the general public, because not everybody who's watching is in our fields. But back to the features and benefits, right? So the contribution limits in a Roth conversion are none. They're limited by the pre-existing pre-tax access. On a backdoor Roth, it's $7,500 or $8,600 a year if you're above 50, and you're virtually unlimited in the rich man's Roth, right? Pre-59.5 access, subject to 5-year rules and a 10% penalty in the Roth conversion, subject to 5-year rules and 10% penalty in a backdoor Roth, penalty-free access at any age in a rich man's Roth. And then there are no RMDs. Advantages and disadvantages. Roth conversion. The advantages are it eliminates future tax risks on large existing portfolio, removes RMD entirely. The disadvantage is it creates an immediate tax liability. Converting too much in 1 year can accidentally push the client into a higher marginal tax bracket. The backdoor Roth. The advantages are it legally circumvents the IRS income phase-outs, allowing high earners to still build a tax-free Roth bucket. The disadvantages are the IRS pro rata rule. If a client has other pre-tax IRAs like a SEP or a rollover IRA, the IRS taxes the conversion proportionally based on their total pre-tax balances. The strategy is also heavily restricted by the low annual IRA limits. Right? And then the rich man's Roth. The advantages are the infinite contribution capacity for massive capital sheltering, no age restrictions on tax-free access. It provides a self-completing death benefit that protects the family by handling debt after death and offers strong asset protection from creditors depending on state statutes. Whereas the internal costs, the disadvantages are the internal costs of insurance and fees can act on a drag on early accumulation, right? Early accumulation. So this is generally a long play. This is a 10, 20 year strategy. But everybody wants to look at that first 10 years, not that next 10 years. It requires medical underwriting to qualify, and if the policy is mismanaged and lapses with loans outstanding, it can trigger catastrophic phantom income tax bond. Now, let's go back to the brother's video. Let's see. The DAP with the ILIT solves a lot of the issues while you're living and for estate tax purposes when you die. Multiple policies set you up nicely for generational wealth policies. Yes, Ra, we are working on that, absolutely. But so many people aren't introduced to these things.
He had too much income for conventional plans and too much skepticism to trust Wall Street with his future. When we introduced the 412(e)(3) plan, it was like flipping a switch. A 412(e)(3) plan is a fully legal, IRS-approved retirement structure that is a defined benefit plan that doesn't have the tax risks of a similar.
Now, I want you guys to know another thing that you may like outside of the 412(e)(3, because again, certain contribution limits, etc., is something called a cash balance plan with a 401h. So, 401h. So let's see, IRS.gov, 401h, IRS.gov. This is a publication from the IRS. So this is in response to your letter dated blank submitted on your behalf by your authorized representative. This letter requests a ruling in regards to the qualified status under Internal Revenue Code 401A and H with respect to a plan amendment to the pension plan, expanding employee eligibility for benefits under the 401 plan, under the pension plan, section 401H, retiree medical account. So you can have a medical account paid for by a 401H to include certain active employees eligible to commence retirement benefits under the pension plan upon attainment of age 59 and a half. So again, you can have a 401H with a cash balance plan, right? Watch this. We're going to go to Gemini, explain a 401H and a cash balance plan. Let's see what AI says here. And yeah, that DAP and that ILIT. See, but here's the thing, Rael. What I realize is that a lot of insurance professionals and investment professionals, CPAs, do not work on the levels that we're talking about. The gentleman who you spoke to, who had the prior experience, right? That CFO was a CFO at another company, which was an investment company. I told you I had a conversation with a member of the board of directors of the OCC. So it gives me two choices here. Choice A, explaining a cash balance plan. A cash balance plan is a high capacity defined benefit pension plan designed to shelter large amounts of business income, while a 401H is a tax-free retiree medical account that sits inside a pension plan. When combined, they allow high-earning business owners to maximize annual tax write-offs for retirement income while simultaneously building a tax-free fund for retirement healthcare costs. Let me see my man Alpaca, if I can invite you up here. Invite. I cannot invite him up here for one reason or another. I'm not sure why. Right? But let's get back to the video.
Defined benefit cash balance plan. You see, with a cash balance plan, which some CPAs are familiar with, there are tax risks such as if the plan overperforms, there is a 50% tax penalty on the excess, and if it underperforms, there's a 100% tax penalty on the underperformance.
Wait, so you're damned if you do, you're damned if you don't. So this has to perform exactly as you say. If it goes $1 above, they're going to tax you 50%. If it goes $1 below, they're going to tax you 100%. But there's still nothing wrong with a cash balance and a 401h when you combine them. Cash balance alone is a little different.
However, with a 412(e)(3) plan, the investments are in fixed rate securities like fixed annuities.
So here's where I dislike the word he used, fixed rate securities. These are not securities. Insurance and annuities are not securities. They are guaranteed. So these are guaranteed products. Now, why is it that most of the time everybody goes for the 401k? Well, as everybody apparently hates giving money to the IRS, apparently you love it because you keep going into the stock market and the 401k. All that is guaranteeing future revenue for the IRS. Things like this are deferring taxes and helping you keep more of your money, which is what you say you want to do.
If appropriate, permanent life insurance with fixed guaranteed values. This avoids market volatility risks for this conservative portion of your portfolio. Plus, it's all exempt from seizure by creditors in most states and even protected from bankruptcy throughout the United States.
So secure, he didn't say that it was secure, he said security. So a security is an investment product, Godly Savage. So not that something is secure, but security. So let me run that back so you can see.
Plus, it's all exempt from seizure by, if appropriate.
See, he says securities. So securities are investments, right? So securities would be stocks, bonds, mutual funds, things like that. So no, a security is not secure. It's volatile. It's variable. Yeah, so if someone says they have their securities license, they can sell securities, but fixed annuities and permanent life insurance are guaranteed. They are fixed products. So being fixed, they are guaranteed and they don't have the volatility or variability. He says it's kind of an oxymoron. Essential planners, you know what? That is very true. And Godly Savage, I don't think you're in financial services, if I'm not mistaken, correct? You don't sell insurance investments or anything like that? So for the regular consumer, this is confusing. He says guarantee, you say. Yeah, what is it, Rael, that you say? Who doesn't like to have their money guaranteed? Right? Yeah, so securities are not guaranteed, unfortunately. But again, fixed annuities, like a MYGA, multi-year guaranteed annuity, or an FIA, fixed indexed annuity, are guaranteed.
Permanent life insurance with fixed guaranteed values. This avoids market.
So fixed guaranteed values.
Volatility risks.
So a security or securities are going to have market volatility risks.
For this conservative portion of your portfolio. Plus, it's all exempt from seizure by creditors in most states and even protected from bankruptcy throughout the United States.
And these are all true things. And many, for example, O.J. Simpson had a lot of money in a cash value life insurance policy. So when he got sued by the Goldman family, they didn't get any of his money, but he just lived off the cash value on his life insurance.
It allows custom contribution designs far beyond a traditional 401k, often in the hundreds of thousands of dollars per year, depending on your age and compensation. Further, we were able to put 90% of the contributions into the owner's plan and less than 10% to the key employees he favored. As opposed to a 401k with much lower deduction limits and a majority of the contributions going into the employee's accounts. It's not cookie cutter. It's actuarially designed around you.
Actuarially designed, right? So he says here, a certain win, sadly, is a turnoff for people. They want the coke rush of getting gorilla fucked by the market. That is an insane. That's so true. They do want the coke rush. You're getting the gorilla fucked by the market. Now, there's nothing wrong with being in the market, right? You should absolutely participate in the market if you can stand it, if you have the risk tolerance. Most people don't. What's the best financial insurance? The best is whatever you've come up with when you sit down with your financial professional, right? And you've been given the options and educated on them of what is available to you, and then you ultimately select. See, what happens is we do this with doctors often as well. We let them say, well, you're the professional, tell me what's best for me. Well, you're the person who has to deal with the outcome of what's told to you. See, I don't have to deal with the outcome of what's told to you. The doctor doesn't have to deal with the outcome of what's told to you. You do. So you ultimately drive the bus. So you ultimately say, doctor or financial professional, list the options, the good, the bad, and then I will make a choice. Now, you can help me influence my decision by educating me. Now, don't ask them to send you some information, because if I send you some information on a 412b3, you're going to be fucking confused. Like if I go here to irs.gov and type in 412b3, you're not going to know. I want my name to make $1 trillion by the seventh generation. Is it possible? Absolutely. It is, but we'd have to actually, you'd have to actually get a paid consult for that, right? So I charge, depending on what you're looking for, minimum $250 for just a budget analysis, up to $2,500 for full fleshed out estate plans, etc. I am not a solo guy. I do have securities licensed individuals. I don't sell securities. I only sell insurances, but I do have a broker dealer that I work with. I do work with estate planning attorneys, etc. And I have some CPAs at my firm. Now, again, this is actuarially designed around you.
Here's how it helped Michael. He made massive pre-tax contributions of $1.5 million a year for 5 years.
$1.5 million a year.
To 2024, he removed the stock market entirely.
$1.5 million a year. So now let's see this, because I want to see what is the max that you can put in a 401k as the business owner is what, 69 grand? So 150, oh, well, hold on. Right? Divided by, what did I say, 69,000? So in 1 year, he put 21 years of what he could put into his 401k. Your average time horizon is 20 years. So 20 years and putting 69,000, right? If we do 69,000 times 20, you could put $1.3 million in there. So in 1 year, he put 21 times what you can put into a 401k. Hold on, I got a phone call coming in, TikTok. This is Alonzo speaking. How can I help you? Hello.
Hi, my name is Antoinette from Consumer Insurance Association. How are you today?
I'm all right. How's it going?
Okay, that's good to hear. I'm calling to help you save on your auto insurance as much as $450.
Sorry about that. I got a phone call. So yes, you can put, again, 21 times, because again, 1.5 million divided by 69,000 is 21.7 times. So you can put 28 times into there. Either dude is balling or 401k matches salary. Well, he's a high earner. That's why he was able to put $1.5 million away. Now, the problem is once he put that $1.5 million away, he has to do that every year. He also has to put a lot of that money into his employees' coffers. So this is why this can be prohibitive for many people. Let's continue.
Entirely from the strategy.
Hold on, let's
$5 million a year. Here's how it helped Michael. He made massive pre-tax contributions of $1.5 million a year for 5 years. And even dating back to 2024, he removed the stock market entirely from the strategy. He gained creditor protection for the funds, and he positioned the plan to purchase the life insurance policy tax-free for personal estate planning objectives. He developed a plan in retirement by integrating it with a Roth conversion strategy and standalone retirement trusts to develop the lifetime tax-free retirement strategies. By age 65, he will have contributed and grown over $7.5 million in protected retirement value completely outside the traditional system. Why 412 plans work for the right business owners who ideally have 15 or employees or less? There are massive pre-tax contributions available in the hundreds of thousands of dollars.
200K to 1.5 million. So again, you can put up to 21 times what you can put into the 401k. So watch this, right? Let's do this. Let's just go straight to Google. Hold on. What is the max 401k contribution for 2026? Okay, so it's 72,000. Okay, so let's do the math again. I was wrong, right? 1.5 million divided by 72,000. So 20 times. I'm sorry, 20 times, not 21 times. I was inaccurate there. So you can put, well, basically 21 times, right? 20.833333333. So again, you can put 20 times as the employer, right, into a 401k in a 412b3.
Further, he got asset protection. The plan was tailored to his age, income, and retirement time.
Yeah, it used to be 69,000. Now it's 72K. So instead of 21 times, it's 20 times.
Timeline.
I admit when I'm
overwhelming
inaccurate.
majority of benefits going to the owner's pocket. Further, there's no market dependency, no roller coaster risk. We get stability and control.
Now I know you're playing
also
God,
integrated
but
into his
however,
advanced
the
tax
thing
and
is
entity planning
that so many people up here who are, you know, these financial pros will disagree vehemently and never admit if they were inaccurate or wrong. Like, I saw your comment, Winslow. Let's see. He says, are we making a rap about this? We might have to do some bars about the 412E3 variation. We may have to do that. Thank you, Constantina. Class is almost over. I've been going for almost 2 hours.
we perform for him. It's legacy.
With my not about the Porsche, about the fiduciary standard.
Ready, because when we combine this strategy with Roth conversion strategies, we can truly impact generational tax-free wealth. So if you're earning strong income, tired of weak retirement tools, and looking for something built for your level of success, let's talk. We offer a complimentary wealth optimizer audit to evaluate whether a 412 plan fits into your business structure, and if not, what better tools might. Click the link near this video. Let's stop deferring and start designing a retirement on your terms. Why multimillionaires and billionaires don't own anything. One of the biggest differences between building wealth and protecting wealth isn't what you own, it's how you own it. Most entrepreneurs spend decades building assets, the operating businesses, the office building, investment real estate, intellectual property, cash, investment accounts. And as success grows, they often...
Hold on, TikTok. What's up, bro? I'm on live.
Hey, so I'm going to put us in a group chat with the...
Go ahead and do that. I'm on live. I'll just do it and I'll call you when I'm done.
Mm-hmm.
All right, later. All right, sorry about that. Yeah, that's how we talk when we're talking to our business folks. He's on YouTube. So he's talking about the 412E3, and his name is Todd Villarubia.
and keep buying everything the same way. Here's the problem. Your operating business creates wealth, but it also creates risk. As your net worth grows, so does the complexity surrounding taxes, estate planning, business succession, asset protection, and long-term family planning. When you're building a business, simplicity usually wins, but over time, life changes. Most successful business owners continue adding assets to whatever structure already exists. Their CPA handles the taxes, their attorney that prepares documents, their financial advisor manages investments. As wealth grows, ownership structure can become part of a much bigger planning conversation. Building wealth is one challenge, preserving it is another. The strategies that helped you build a successful company aren't always the same strategies that help protect it over the next 20 or 30 years.
Okay, so let's see if he's got anything else here. The unreported income crisis that every CPA faces. Let's click back. Let's see what else, because like I said, I just typed in 412E3. Would you buy a 200K money judgment? I don't know enough about that to say that I would. 49 business owner tools. This was done 2 weeks ago by somebody named Michael. Let's look at his channel.
Business owner tools, 412E3. A 412E3 is defined benefit plan, funded only with fixed annuities and life insurance. Powerful for business owners and key talent. It creates guaranteed benefits and allows fully deductible employee contributions. This plan is powerful for business owners and key people. But the question is, could a 412E3 help you attract and retain top talent while building your own assets and those of your business?
So let's look at what Michael is about here. He has a bunch of links. Bank Like a Billionaire, 6-Pillar Legacy, options trading. So let's see, retirement, income that grows. Let's look at this. Transform your retirement from financial freedom to purposeful living. Let's see what the other link he has here is. 6-Pillar Legacy. What is this? Craft a life and legacy that endures. Okay. Practical frameworks from a 20-plus year investor, author, and legacy builder. Let's see what else he's got here. Bank Like a Billionaire. Let's see what this is. Bank Like a Billionaire. Insurance that powers access, protection, and calm compounding. Okay, so I'm going to give this guy a follow. And ladies and gentlemen, I'm going to go ahead and shut down. Wipe ass. Work in progress every day and see success. I'll be back in about a half hour. And let's shut down this line. Salute y'all. That I end.